Can you see me?
Mm-mm.
Is it on your screen or my screen? Hello, everybody. Welcome to our show. Alyssa, let's see how we can. Are you on the StreamYard screen?
I can see myself. Yeah.
Okay.
I just can't see you. That's okay.
Okay. Well, you look great. We look great together.
Thanks.
Welcome to our Money Monday with Purse Strings. My name is Maggie, and I'm a partner here at Purse Strings. We're all about coming every week and giving tips, tricks, pieces of advice on how to be financially fearless. And then when you're ready to start investing, plan for retirement, maybe you're getting married, maybe you're getting divorced, you need estate plans, we have top tier financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Alyssa Calhoun is one of them. And we're so excited to have her on today. Since all of March, we're talking about investing, and one of these key words we hear is asset management. So we're going to try to understand that a little bit today with Alyssa. But before we dive in, Alyssa, could you give us a little intro of who you are and what you do?
Yes. Hi, Maggie. Thank you for having me on today. I am Alyssa Calhoun. I work with CAM Investor Solutions. I'm an associate wealth advisor with them as well as their communications director. So I do a lot of the marketing and outreach to our clients and on our website, social media. So I'm glad to be here. And my whole career has been in investments, asset management, and financial planning.
Awesome. Well, we're so excited to have you on today. And so, like we said, we're going to be talking about asset management. And let's just dive into what does this even mean, asset management? I know it's a big buzzword around investing.
Yeah, it can mean a lot of different things. So I Googled the Investopedia definition just to start with that. And so we'll have like an official definition and then I'll kind of boil it down. So the official Investopedia definition is the practice of increasing wealth over time by acquiring, maintaining, and trading investments that can grow in value. So it's kind of a mouthful of what it means. But to boil that down, it's basically the continuous review and maintenance of someone's assets. That's all the different types of investments or cash-like assets that someone holds. So if you think about your household and your pantry and you create a shopping list, you're trying to make sure that you have the right amounts of fruits and vegetables and grains and proteins and in the right amounts for how many people are in your house. So that's kind of the same thing when you're thinking about your financial portfolio. You want to have the right mix of all those different ingredients or pieces, and then the right amount for what you need for your goals. So a wealth advisor or a financial advisor, it's their job to review and maintain that right mix for that specific client. So everyone should have a specific mix or asset mix for them. And not be so generic. The generic is, not right for everyone, just like your diet, right? It's not right for everybody to eat this many calories versus that many calories. So it's the same kind of thing when you think about your investments and the specific assets you're invested in.
It's a great comparison. It makes a lot of sense, because you try to think if you already have something or how many people are coming over or whatever that, equation may be. There's vegetarian, you got to plan differently. And so since we talk a lot about, working with a financial professional, it's different because it's not, since we are all unique individuals, we're not cookie cutter. This really kind of emphasizes that, again, we can't all be in that same bucket. So we need to each have our own different, management of our assets.
Absolutely. Yeah. And that's what we try to strive for people is that you can watch people on TV and they can tell you to buy this or invest this way, but they don't know you. So they don't know what's the right thing for you. So that's why talking with someone one-on-one that gets to know you, they'll make the best recommendations that are specific for you, like a doctor or a nutritionist would.
Right. Awesome. And so how does this play into the whole picture of investing?
So it's really the central part. If you think about like a car, it's like the engine. It gets you from point A to point B. Without the engine, the car is just, I don't know, a hunk of metal with some attachments, some accessories. But the engine really is getting you from where you are and where you want to go. So if you think about that, the individual stocks and bonds you might buy, you might be watching TV, or you might hear a friend at a party say, you got to buy XYZ stock. That's just kind of like putting on, putting in leather, putting in a backup camera, things like that. It's pieces of it, but it's not the whole thing. So the asset management is how it fits together, and knowing how stock A and stock B work together, or how bonds and stocks work together in your portfolio at the right amount to get you to where you're trying to go. So it's really the central part that really is the plan that gets
Yeah.
um, to achieve the goals you're wanting to achieve.
Yeah, that makes sense. I mean, a car's no good without that engine, as we all know.
Yeah.
And so I know you kind of listed some of these through talking, but what are considered assets when investing? It's not, yeah, I'll leave it there.
Yeah. So we actually have a chart on our website that has the kind of investable universe, and so it's a lot more than just the traditional stocks and bonds that people think about and have heard about. But even within those stocks and bonds, I'll talk about that for just a second. There is various layers and levels. So if someone's like, you need to be invested in stocks, there are so many different kinds of stocks. So there's large cap stocks, those are really, really big companies. There are small cap stocks, those are smaller, more regional, probably companies you can invest in. You can invest in value stocks, those are lower priced stocks. There are growth stocks, those are the really expensive, like, $1,000 plus per share. That's a really expensive growth stock. So, knowing the differences of those kind of stocks and knowing which ones historically through academic research perform better than others. And then there's also stocks in the US and outside the US. So the US, if you think about just the companies in the US that are publicly traded, that makes up about 60% of the global makeup of all stocks. So if you only invest in the US, you're leaving 40% of your options off the table. So those other 40% might be the winners that year. But if you don't invest outside the US, then you miss out. Then if you think about bonds, there's a lot there with bonds. There's government bonds, there's corporate bonds, and then there's various levels of ratings. So some are really, really safe bonds, and some are called junk bonds. Those are really risky. They sometimes have higher returns, but they also sometimes completely miss the mark for you. And then there's different lengths. So some are super short, 3 months, 6 months bonds to like 30 years. So there's a lot of variation within that. And then the same thing like stocks, there's global bonds, right? And it's different in the US. 38% of all bonds in the world are in the US. So that means over 70% are, or 60% are not here in the US. So that's a lot that you leave out on the table if you don't consider investing in bonds outside the US. So there's a lot there. So that's the traditional stocks and bonds, and in there's a lot. And then there's other asset classes like real estate, commodities. Commodities are things like cattle, wheat, oil, gold is a very popular one people like to talk about. And even Bitcoin or like digital currencies is a new asset class. It's not one we invest in right now for our clients, but it's one that we watch. Anytime there's a new asset class like that, which there's not usually often a new asset class, but when there is one, we watch it and kind of see, where it goes. And then really the biggest part of all of the assets out there are private. So there's private equity, there's private debt, and there's private real estate. And those are good to have in your portfolio because they usually do not correlate with what's happening in the stock market or the bond market. So when the stock market's going up and down or doing whatever it's doing, the private world is not usually doing the same thing. So it's a good balancer. It's good to have that diversification. But it is harder to get access to that private stuff. You usually have to work with a financial advisor and investment professional to get access to them. So it's definitely a great thing to have in the portfolio. It's just a little bit more. You just need to be more careful and more diligent, I guess, with looking into those type of investments.
So yeah, there's a lot of different assets that you can invest in. And clearly, each class has, all these little under trees of even more information. And so, that's one of the reasons why we say talk to a professional, is because nobody here needs to be doing the deep dive into that research. That's what a professional's for. Because as you can see, there's a ton of information to kind of dig out and uncover to figure out what's best for you. International, national, stocks, bonds, private. I mean, there are all these different moving parts.
Yeah, and even within there, I didn't even cover people's personal preferences. Like some people are environmentally conscious.
Yep.
And so there are investments out there in stocks, in bonds, in private, all of those things I just described that have a focus on environmentally friendly or social issues. So you don't want to invest in a company that does child labor or ammunitions or in countries where there's political unrest, those kind of things. There are assets in all of those classes that pertain to that. So there's kind of something out there for everyone, it seems like. But that doesn't mean that they're all good or that they're all things you should be investing in. And so they do require a lot of research and diligence to make sure that just because it has a good title or, sounds like it meets your personal ideals or values doesn't necessarily mean it's the right investment.
Right, right. And that's why I always think it's so interesting if people are like, I have $500, what should I invest in? I'm like, that can be so broad. It could be 1,001 different things. And if I knew, I would be the next Warren Buffett, but I don't. And nobody does, even though you're so well versed in this, you don't have a crystal ball that I know about. But if you do, we could talk later. But you just don't know. And so that's why you do need to have these conversations, because there are so many options out there for people.
Yeah, I get that question all the time. And then I start to ask them, I'm like, well, tell me about your other, what else do you have like in retirement or in savings? Or is this money, for college, or is this money for you're trying to buy a new car in a year and you're trying to grow that 500 to 10,000? Or like I start to ask more questions and then they get kind of like, why do you need to know all that stuff? Like, just tell me what's the right thing right now. And I'm like, there's not one thing I can tell you right now based on that one question.
And so, how does someone work on making this decision of which asset to invest in? I guess it's going through some of these questions.
Yeah, so there's a lot to think about. It's which of those assets to invest in, how much to invest, and then you have to pick. Once you pick the assets, you can say, okay, I want to invest all my money in stocks. Like I said, there's all those different types of stocks. So then you have to make the selection of which specific stocks or group of stocks you're going to invest in. It also depends on a person's risk tolerance, their goals, liquidity needs. That means like, do you need cash soon? Do you need to take that investment and sell it and use the cash in the short term, near term, long term? And then that time horizon, right? So like, when do you need that cash and that investment to kind of play out for you? And once you've kind of established that, you have an idea, a roadmap of what is the right investment or what are the right investments. So, for example, if someone needs cash or that money in the short term, then we would say you should probably invest in something that's less risky, that's more liquid. So it's not really hard to sell it. You can easily, quickly sell it. It's not going to have the best return because it's a very short, low risk investment, but it also kind of ensures that the cash is there for you when you need it. So those are things like your kid's college in the next couple years, a car, a down payment on a house. I definitely wouldn't say go put that in Bitcoin. If you're trying to buy a house anytime in the next 5 years, that would be very risky. If your time horizon is longer, like a retirement account, your 401k, an IRA, something like that, you could put it in more stocks or more risky assets. Because those little bumps in performance, like last year, was a bad year for stocks and bonds. If you have 20 or 30 years, that's going to look like a tiny little blip on your performance chart. And so there will be many of those blips. Like they say, there's no such thing as a free lunch. So you're going to see those little blips, but it'll kind of smooth out and it won't hurt so much to your brain, like emotionally hurting you. They're like, oh no, I'm losing money. But it also won't hurt so much of your actual dollar values in your portfolio if you have that longer time horizon. So, like we talked at the beginning, right? It depends on a lot of things that are specific to you.
Definitely. Yeah, that time is a huge thing. Just trying to figure out how, when you might need this money and kind of what your goals are as well.
Yeah.
And so, if you talk with a professional, kind of figure out your asset investments, or your asset management, how often do you have to go back to this plan and kind of reconfigure it, or make changes to this plan?
So you would make changes to your plan if your goals change or some big life event happens. You get married, you get divorced, you become a widow, you lose a job, you have a child, you lose insurance of some sort, and you need to have cash to cover different life events that could happen. So anytime there's kind of a change, we tell our clients, like, don't call me at the grocery store and ask, should you buy this steak versus the pork because of a price difference. Like, we don't need to talk every time like that, but before you buy a house, before you timeshare, that's a good one, before you buy a timeshare, call us and we can talk about it. Different things like that. If they want help with buying a car, I'm not going to go to the dealership necessarily with them, but I can help them price around for different rates. We can talk about leasing versus buying, the difference there. How does that affect their cash long term? Especially if they're like, I want to buy a new car every 3 years. We definitely want to talk about that, how that affects their plan. But as far as changing the investments themselves, that is a big part of what a financial advisor, wealth advisor helps their clients, is to stay calm and not freak out when the market goes down or their specific investment goes down, because we want to stick to that plan. So there's kind of two different camps of investment philosophy. Your investment philosophy is kind of the way you think about the market. So if you think markets are efficient, that means that you think that the prices of stocks and bonds and the different things are pretty accurate, then you have a passive investment philosophy. If you think that stocks and bonds and the prices of those assets are not correct, and that you can find mispriced investments out there, and you're trying to buy at the right time when they're low and sell when they're high, that's called market timing. And that investment philosophy is more of an active approach. And so it kind of depends on your philosophy, on how often you would buy or sell the investments in your portfolio. Academic research has shown over time the active investing, trying to pick winners and losers and trying to time the market at the right lows and highs, hasn't actually paid out over the long term versus passive. So it's a lot of emotion, it's a lot of money, it's a lot of time and research that someone has to do that's doing that. And over time, it hasn't really proven that it performs any better. Usually it's worse long term. It's a lot of being right that you have to do to really make that pay off. So for us, for our clients, we do rebalance, so that plan stays on track, right? So your car is not veering to the left lane or the right lane, you're staying in your lane. So we rebalance, but we're not trading in and out or chasing trends or the meme stocks when that was popular years ago. We're not doing any of that, because that's not keeping you on track for what your goals are with your
right. Yeah, it's that long-term plan. It's that commitment. It's not being swayed by the people, by the noise, by the social media, but just kind of sticking to what's tried and true. And if you've watched any of Warren Buffett's stuff, I mean, he's pretty set it and forget it, and that's why he's so much wealthier, is because it's that time, but then just leaving it.
Absolutely, yeah.
Yeah, and it's kind of like a car. You might go get your oils changed, or your wheels turned, but nothing major.
Right. Yeah. You get off the highway when you need gas. You don't get off the highway every time. Well, if you're my grandfather, you do when you see the historical marker sign and you're like, oh, what happened here? What happened there? But generally, yeah, you're staying in your lane. You're staying on the highway. You get off for gas. You get off to rest. You get off at kind of regular intervals to make sure that you can still make it to wherever you're trying to go.
I love that. And so, if there are changes that need to be made, let's say you are getting married or getting divorced or something, big is happening, just like cost to make changes to your asset management plan.
So with your financial advisor or your wealth advisor, it doesn't cost anything, right? That's part of your relationship, and their responsibility to you is to help you update that plan. The cost of actually changing investments, now there's a cost to that sometimes. So it depends on the type of investment. So if it's something like an ETF, usually most custodians, that's where your money is held. So like a Fidelity, a Schwab, those ETFs are usually free, not always, but usually they're free to buy and sell. If it's something like a mutual fund, there might be a fee like $5 or up to $50 to buy or sell that security or that investment. And then it depends on who's doing it for you. So if it's usually your wealth advisor, your financial advisor, there's usually no fee. If you're using some sort of broker, there might be a commission. And so that was like back way, kind of Wolf of Wall Street type of movies, that you would watch, that they were trying to get you to buy and sell, because every time you did, that person on the phone getting you to buy or sell was making a commission off of that person in that sale.
Right.
So that doesn't happen as much anymore, but it can still happen. So it's definitely important to know how the person you're working with gets paid. And so you're asking them, are you paid on a commission? What's the commission for, or how do you make that commission? And so it's really important to know whoever you're working with, how they're getting paid. So there can be some real big costs that could add up that eat into the investment returns if you're not careful. And usually in active management, you're trying to do those buys and sells and pick at the right time. And so there is more trading that happens in active management. And so that's another reason why over long term, active management hasn't proven to do so well, is not just are you trying to guess the right price of the stock or the bond, but you're also trying to avoid, or anyways, those trading costs add up and eat away into that. And then a big cost, you and I were talking about taxes earlier, is a tax consideration. So some people don't think about that when they're buying and selling, but it's absolutely something you should consider, because it doesn't show up when you hit sell, that it's like, oh, by the way, here's your after-tax amount you're going to receive. So if you're holding it for less than a year, that would be a short-term capital gain if you made money off of it. And that tax is based on your income bracket. So if you're in the 37 percentile bracket of your income, your short-term gain is going to be taxed at 37%. So it can be pretty costly. If you've held it for more than a year, that would be a long-term capital gain, and that tax is much lower. It's usually 0%, 10%, or 20, and that's still based on your income. But even if you're in the 37 percentile bracket, you would only pay a 20% tax versus a 37% tax. So knowing that stuff can really be helpful, and something to keep in mind when you are buying and selling.
Yeah, those could make some big dents to your profits. But by the time you actually see what hits your bank account, and so I can see why you want to do this strategically. And you might want to work with someone who understands those tax nuances, or if you have a big tax thing, have a tax specialty, because at the end of the day, that can eat up a lot of your funds if you do it in the wrong way. And I know there are many people out there who can help, who know the different laws and how to kind of go and get the best tax break, to get as much money as you can in your funds.
Yeah, and a lot of financial and wealth advisors like our firm, we do tax planning. So that is
awesome.
Something that we consider when we're doing that plan for our clients. Something we haven't talked about is asset location. So that means, where are your investments located? So are they in a 401k, or are they in a taxable brokerage account? Or are they in your kid's 529 account, or some other type of youth account? So depending on the type of investments, you want to put them in the different types of accounts. For example, more tax efficient investments like an ETF or a municipal bond, you'd want that in a taxable brokerage account, because any kind of gains or dividends that are kicked out, you're going to have to pay tax on that. something that's kicking out a lot of dividends or is not tax efficient, you would want to put that in a tax deferred account. Those are things like your retirement accounts, your 401ks, your IRAs, your Roth IRAs, even your 529s, like a 529 or a HSA, that's a health savings account. If you take the money out for the right things, those are tax free. And
Right.
so having things in there that are kicking out a lot of cash or dividends for you, that's okay because it's going to be tax free, used for the right things. So that's called asset location. That's different from asset allocation. So the allocation.
Oh, that's a good tip right there.
Yes, they're very different. Location is what type of account is it in, and allocation are how much of your investments are put into stocks versus bonds versus private investments versus real estate. That's allocation, where you allocate to.
Got it. Awesome. Well, yeah, I feel like this has been a ton of great information, and I love that you know the asset location as well, because like you said, that has to do a lot with your taxes, which is essential. And I know everyone's talking about that right now as well. We've touched on a lot of great topics. Is there anything that we didn't touch on that you want to make sure is shared today?
I think just that investing is great, and the sooner you can get into it, the better. With the whole time value of money and compounding, right? The younger you do it, $5, $10 a month adds up over 30, 60, 70 years. And so the sooner you can get into it, the better. And there are lots of people out there that want to help everyone figure out what's the right investments for them. And there are lots of different price points of different advisors. There's things called robo advisors. Those are more kind of like automated online advisors that can help you get started if you have, $5 a month you want to put in, up to other advisors that can really manage everything for you, from helping you figure out insurance to your estate planning, figuring out legacy planning, helping you think about charity investing and how to do that the best way, and also tax efficiently, tax planning. So there are a lot of different types of advisors out there that can help you based on your goals and your entry point into investing. So I just say find someone that works for you and just start.
I love that. Yeah, it's important to get started because part of that equation is time. So we want to make sure we have our time in there. And so I know you're located in Texas. Where else can you, are you only licensed in Texas?
No, we're licensed in everywhere in the U.S. So
awesome.
in any state, we have an office. I'm in Austin, Texas. So if you wanted to meet me locally, that's where I am. We do have an office in Denver, Colorado, and then one in the Tampa, Florida area. So that's where we physically are, but we meet with clients virtually. We were doing that before COVID, so we already had a system in place. And then after COVID, just more people were willing to meet virtually, even like in the same like kind of suburb of Austin. They're like, yeah, it's just easier to hop on Zoom. So we're flexible, but we love seeing our clients in person if they're in town or if we make it to wherever they are to go visit them.
Awesome. So yeah, don't be afraid to reach out to Alyssa. She can serve your state, which is always important to know about your financial professional. And so yeah, I appreciate you coming on here today and sharing your expertise. Anyone could reach out to Alyssa. Her email's been going through the bottom here, alyssa@caminvestor.com. She's also one of our Purse Strings approved professionals, so you could reach out to her off our site, pursestrings.co. And like Alyssa said, just jump in, $5, $10, whatever it is. Let's just get you started. And I think getting started is the hardest part. So let's just rip that Band-Aid off and get going. So thank you again, Alyssa, for jumping on today.
Thank you, Maggie. I appreciate it. It was a good time.
Yeah. We'll talk to everyone soon.
All right.
All right. Bye-bye.